Okay, welcome to our final presentation on mutual funds investments for the masses. Did you go back over that previous presentation and make sure you understand the different types of mutual funds, the major categories, realizing there are many subcategories and subcategories and subcategories? I hope so. Because today we're going to take a look at a single mutual fund out of the 12,000. And then if you look at a few more. And let's start with slide number 16 and fund families. A family of funds exists when one investment company manages a group of mutual funds. See, decades ago, a company might have one or two mutual funds. But then, as we saw in the 1980s and 1990s, there was an explosion of mutual funds because if one company offered this mutual fund, then everybody else had to offer it. And so, my goodness, there were just more and more mutual funds. So now we have these family of funds. The funds in the family vary in their objectives. You can move your money from one fund to another in the family, almost always with no charge. You paid the commission already. It depends. Sometimes if you do quite a bit of moving around, they're going to say, don't do that anymore. And if you do, we're going to charge you 2% every time you do it. But in general, no. If you had the fund for a few years and now it's ready, you're ready for something more aggressive, more conservative, go ahead and move. But the IRS says if it's in a taxable account, you could and probably will generate a taxable transaction. If it's in a 401k, 403b, Roth IRA, other type of what the IRS calls tax qualified account, retirement account, educational savings account, health savings account, then no, you don't generate any taxable transactions. It's only when you take the money out that the IRS is interested. And Forbes said this many years ago, and I just think it's the best thing. Choose a family, not a fund. Yeah, you want to find a family where most all the funds have done well and have, of course, they have to have the objectives that you're interested in too. But yeah, the major fund families all have, in my humble opinion, plenty of options. And here are the top 10, sort of, maybe, we're not quite sure, because it's kind of hard to get this data and different sources give you different results. One major boo-boo that some of the sources do is they put BlackRock before Vanguard. BlackRock is a bigger money manager worldwide, but with regard to mutual funds, they are second behind Vanguard. It used to be that Fidelity was the largest for many decades, and then Vanguard overtook them with their push for index funds. And then you might have heard of the American funds. They're changing their name back to what it originally was, and that's the Capital Group. So now they're the Capital Group American Funds. State Street Global Advisors. This is a company that helped other mutual funds for many decades. Then they started their own. T. Rowe Price, a very good company based in Baltimore. Excellent funds, really good company. I like them. They're like American funds and Dodge and Cox. They work with a management team as opposed to individual managers. And then Invesco, they bought Oppenheimer, which was a storied company for many decades. And so now some people still think of them as Oppenheimer, but Invesco bought them. So now the Oppenheimer name is gone. And then DFA, the Dimensional Fund Advisors, is a very popular family with advisors. There's some excellent funds. PIMCO, Pacific Investment Company. Believe it or not, it's based in Newport Beach, of all places. But again, all 10 of these companies are worldwide. And then Franklin Templeton. We saw Mr. John Templeton, right? Sir John Templeton, back in chapter 12. Yeah, Franklin Templeton is another great company. They're all very good companies, folks. I have my favorites, but you won't go wrong with any of these companies. Oh no, I'm not a big fan of Invesco, but that's okay. Not because of what. No, because I think Oppenheimer, when it was Oppenheimer, was a better. Well, we're splitting hairs. My apologies. So any of these companies, look at their websites. The cool thing about their websites now is that they're doing more education. Really like that. Really appreciate what they're doing. And some of them, Dodge and Cox is not in the top 10, but they are awesome. Check out their website just to read and listen and watch their commentaries on the markets and the like. But all of them have pretty good websites. Now, because of the mutual fund scandals of 2003, 3 companies that were in the top 10 are no longer there. Wait a minute, Payano. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, as a matter of fact, I do, yeah. Look, since 1940, the mutual fund industry has been regulated and escaped any hint of impropriety. You know what that word means, impropriety? It's a fancy word for hanky-panky, travesuras, trucos, trickery. Yeah, in 2003, some practices that were not quite illegal, but obviously unethical, were uncovered, and only a handful of funds and people were affected. I mean, Alliance is a great company, folks. Now it's called AB, Alliance Bernstein. AB, what a dumb name. But there were two people in a huge mutual fund industry that were doing these tricks, these impropriety tricks. And the whole company almost disappeared. Alliance almost disappeared and got swallowed up. But then they merged with Sam Bernstein, and now they're AB. Bank of America, yeah, they had funds. Putnam, poor George Putnam, rolling over in his grave. A storied mutual fund company that's been around for decades. Janus, which I've never really been too excited with Janus, but Strong Funds. This is the real tragic one. This is, if you like Greek tragedies, here's a Greek tragedy for you. Richard Strong, who built this company from nothing, and at the time he was doing this, he was worth some $600 million or something like that, or whatever. I don't know, just outrageous amount of money. And he was playing the game. Where what were they doing? It wasn't illegal, but it wasn't. So let me give you an example. The markets move in different, rhythms, but more and more throughout the world they move in tandem often. Not always, but in tandem. So you know that if the market tanked in New York, for example, and it closes at 4 p.m. New York time, 1 o'clock California time, a couple hours later, it's going to open in Japan. So often what happens, but not always, if the United States markets fall, say 2%, it's very likely that Japan and Hong Kong and the Far East is going to fall a few hours later. So what these people were doing is they would sell their Japanese fund in New York before 4 o'clock, because all at 4 o'clock, that's when the prices are all recalibrated. After the market closes at 4 o'clock in New York time, they would sell their Japanese fund. Then the next day, they would expect the Japanese fund to fall, because probably the Japanese stocks are going to fall. And the next day, they buy it back. You see what they were doing? They were turning the mutual funds into trading vehicles, which they're not supposed to be. Right. And some companies like Vanguard and American just said, no, you can't do that, okay? You can't do that. Don't do that. And if you do, we're going to kick you out. We don't want you. Other companies like Franklin Templeton would say, sure, you want to do that? We're going to charge you 2%. And we're going to take that money and give it back to our shareholders. So you see, they were shaving off little pieces of pennies. But of course, if you do that with 1,000 shares, right. And Dick Strong, he made something like 80 grand or something like that, which to you and me, that's a lot of money. But to somebody who's worth 600 million, it was nothing. And why did he do it? He was so upset with himself. He said, I've ruined my life. I've let down all the people who looked up to me. They start to, it's the Greek tragedy. They start to believe that they are invincible, that they can get away with anything. Certain ex-presidents running for presidency again. And he was barred from the industry for life. But more important, don't worry about him. He's fine, folks. He's got plenty of money. Don't worry about that. But he's lost his most important asset, in my humble opinion, and that's your good name. So you didn't think you would see Greek tragedies in in the financial world, but they're there. The vast majority of companies never engaged in these shenanigans. And so what happened, right? Instead of losing $99,999 on your $100,000 account, for example, the Enron employees that were encouraged to keep their 401ks in Enron stock as Enron was going into bankruptcy, Investors lost less than a penny on a $100,000 account. But with millions of accounts, you can see that it adds up quickly. So don't worry. The industry is highly regulated. The major players are all very, very reputable, in my humble opinion. Some of the minor players, I'm not too excited about, but I don't know anything about them. I basically keep my eyes on the big boys and girls in the mutual fund industry. So, how do you pick a mutual fund? There's 12,000 of the darn things out there. There's all different categories and types. Well, here's my advice for what it's worth. Pick a mutual fund that invests in high quality stocks or bonds and is well diversified across several industries and sectors of the economy and the globe, in my humble opinion. I'm a big fan of global investing, although it hasn't worked out as well as staying domestic since the Great Recession. But if you go before that, 50 years before 2008 and 9, they basically were the same, outside the United States and inside the United States. They moved in different times in different directions. But since then, no, the United States has just zoomed way ahead of her. It's not that they have stood still. It's just that the United States has done a whole lot better. And also, you want a mutual fund company that has a long-term perspective and a manager, or better yet, as we've mentioned, a management team with many years of experience. Now, you want to avoid companies who shuffle their managers every few years, which used to be most of them. This was Fidelity's modus operandi. And the guy who started Fidelity, the grandfather of the woman who runs it now, basically said so. He said, look, the market will determine who stays and who leaves. So here, kid, you're out of Harvard or Wharton School of Business or Chicago University, Chicago School of Business, Stanford, whatever these people are very, very powerful. Here's kid, but they're young. Here's $1 billion. See what you can do with it. And some of them did very well, and some of them didn't do very well. And so that to me was counterproductive, because you're buying the mutual fund for more stability, more diversity, more continuity. And you might get another Peter Lynch, who ran the Fidelity Magellan Fund and racked up 29% for 13 years. Or you might get Charles Stedman, who lost 43% over decades. Yes, okay. So yeah, that's why I like teams. One person leaves, it doesn't ruin the continuity. Plus, they not committees. Make sure they're not committees, because committee, everybody has to agree on things. No, we want that dynamism. We want somebody saying, I want to buy Microsoft. No, I want to sell Microsoft. That's fine. That's really good. A couple of companies, pushed this since the 60s. American Funds being one of them, T. Rowe Price and Dodge and Cox. And now many companies use this technique. And you want a mutual fund that's been around for decades and performed consistently well in good and bad markets. See, when people tell me, well, look how well it did during this good market. No, I ain't interested. I want to see how they did when the organic matter hit the ventilating device. I want to see how they held up when the markets fell. Because that's when I believe me as a broker and the industry itself makes their money. When things when people are running around screaming and hollering and they think the world is going to end. Because if the world doesn't, it doesn't matter where your money, if the world is. But we always come back. I believe, as I've said, I know it sounds like an advertisement, my apologies, but the next 20, 30 years should be the best years economically in the history of the world. We should have more people coming out of poverty than ever before. We'll see. We'll see what happens. We could blow ourselves up, die in our own waste. Meteorite, major earthquake that destroy, disco returning, whatever. But I'm optimistic. Okay, so let's take a look now. From the 12,000 funds available, let's take a look at a single mutual fund. It's called the Investment Company of America. It's been around since 1934. It's actually been around before that, but when a manager changes, they restart the clock. So they've been doing 12% for over 90 years. Now remember, if we invest in stocks and we get 8, 9, 10%, we are very, very happy. But these people, and they're not the only ones, folks, these people have been doing 12% for over 90 years. Now, there's a few little presentations that I want you to check on, right? Normally in the face-to-face class, we would stop and show them. There's the 90-year history, then good times, good, worst days, bad days, when's the worst day to invest, when's the bad day to invest, keeping a long-term perspective. What if you held the money for 1 year? Well, there's a 1/3 chance you'll lose money. Held the money for 3 years? Well, it goes down to 1 in 7, 1 in 14 if you hold the money 5 years, and then 1 in 0, 0 in any, you never lost money as long as you held it on for 10 years. And so the important thing to remember with stocks is that you want to have a long-term perspective. You'd want to not panic when the markets turn, because downturn, when there are market downturns, because that's the worst time to sell. Ooh, is it too late to get out? When you hear people say that, yeah, it's too late to get out. Yeah, so don't do it. Hold on, that's the time. And people, really intelligent people, folks, some with things like PhD next to their names, have come up to me and said, "Oh, I sold everything. Why? Oh, I just want to wait till it's a better time to invest." And I want to say, I don't say it. I say, "Oh, you have to keep a long-term perspective." I try to stay positive. Meanwhile, I'm thinking, "You stupid pigeon! You've been skewered, plucked, and roasted. Do you understand what you've just done?" Keep your mouth shut. What about market downturns? Keep a long-term perspective, and we mentioned this thing. We're going to take a look at it again in detail. Dollar cost averaging, slide 21. It's a horrible name. I've been trying to come up with something better. You might hear, first of all, sometimes the dollar and the cost is hyphenated. Sometimes it's not. I don't know what the real thing is. What one is better. A systematic investment plan. Systematic, how's that sound? Automatic investment plans, that sound good? I don't know. But you're going to hear dollar cost averaging. It's a system of buying an investment at regular intervals with a fixed dollar amount. You see, the cool thing about dollar cost averaging, and I had to convince my wife many years ago when we first got together because she was terrified of stocks. Is good. We want to have a healthy skepticism because they, as we saw, they can go bad on us very quickly. But with dollar cost averaging, when you wake up in the morning, there's always good news. Oh, the market's up. Good news. Yippee! Your $100 is now worth $100.20 or whatever. The market's down. Good news. Huh? Yeah. When do you want to buy things at the Walmart or the JCPenney's or the grocery store? When there's a sale. Next month, you're going to get more shares at a lower price when the $50 or $100 comes out of your paycheck or checking account. You see? So the cool thing about dollar cost averaging is you don't worry about whether it's a good time or a bad time to invest. Every month is a good time to invest. Now, some months it's going to be high, some months it's going to be low, and you're not going to pick the worst time. You're not going to pick the best time. And that's why that worst time, best time instrument that's on the website, it's in Canvas, is a pretty cool thing to look at. Cool? See? Now it all sounds so boring, doesn't it? Good! In the investment world, boring is good. Most of us are not going to be interested in following stocks, not going to be interested in doing all the legwork and some people love it. Some of us love it. Some of it's a hobby and it's profitable. Most of us have got kids to raise, jobs, maybe in nursing or in teaching or whatever, and they just don't want to be bothered with it. And that's why dollar cost averaging in mutual funds will bore you to wealth. Now, slide 22, most mutual fund companies have a system for what are called hypothetical illustrations. Hypotheticals, illustrations. Life insurance companies have these things too. They're examples of returns of investments, either for a lump sum principal. For some reason, they use $10,000 as the default. I think that's dumb, but hey, how many people have $10,000 lying around the house? Or streams of investments, which is another way of thinking of dollar cost averaging, $50 a month, $100 a month, or a combination of both a lump sum and a stream of investments. They must be approved by the Securities and Exchange Commission, the Financial Industry Regulatory Authority, and contain disclaimers about past versus future results. The investments are not FDIC insured, nor are they banks or deposits of any entity that may lose value. All this other stuff that nobody reads or understands and whatever. So in the face-to-face class, we would stop and take a look at the hypotheticals that are on the class website and in Canvas. So check them out, dear students, now. And we saw them for the stocks, and we saw stocks have done pretty well. And we saw them for bonds, and we saw, oh, bonds are kind of boring. But now we're going to take a look at a balanced fund. A balanced fund that invests in stocks and bonds. So it gives us some of that juice, that sexy excitement that stocks give us, and excitement unexciting when stocks fall, growth, and they give us stability of bonds, the income of bonds, and the stability, the ballast for you nautical fans. And it turns out that they've done pretty darn well. Whole lot better than the bonds, not as good as the stocks, but not as volatile. Remember, in our world, volatility means, oh, I lost a lot of money. Okay, so slide number 23. Here's the money pitch. That mutual fund that we showed you, because we had to pick one, is not the only mutual fund out there that's done well over 50 years. This is the slide from back in chapter 1. Do you remember it? There are mutual funds that have been around for over 50 years that have done better than 10%. Yeah, look at this one. Growth Fund of America. You like that? Income Fund of America. That's the American funds. They weren't really called American funds. They were called Capital Research and Management. And then they changed their name to Capital Group. But everyone called them the American funds because they had names like American Mutual Fund and AMCAP and Washington Mutual Investors Fund and the Growth Fund of America and the Bond Fund of America. Now they want to change it. They want everybody to know themselves as Capital Group. And there's Fidelity. Look how many Fidelity has. Fidelity Contra Fund. Woo, woo, woo. 12.62. Look how many. Franklin's got a couple. Actually, Franklin's got 3 because the Templeton Growth Fund is part of Franklin. And then there's T. Rowe Price, another great fund, folks. MFS is a fund. This is actually the world's oldest mutual fund company here in the United States. There's actually a Scottish mutual fund company that's been around since the late 1800s. So there's Vanguard's offering. And who else? Invesco, that's Oppenheimer. It used to be called Oppenheimer. And where's Dreyfus? Dreyfus Fund is now owned by Bank of New York Mellon. And so they're out there. Now, would I recommend these funds for you? You can do a whole lot worse. But in general, except for a couple, they're mostly all domestic. And that's only because in the United States, people didn't start investing overseas until the 1960s or so. And so here is one that's, here's the Templeton Growth Fund. He was one of the first people. In the 1950s, he started investing overseas. That's a global fund. And then this one, New Perspective Fund, is one of the American funds, and that's a global fund. So you'll notice that most all of these are domestic funds. And so starting from a clean sheet of paper, I believe that most investors are best served with a global fund. That's my perspective. Many other people will say, oh, Payana's all fuddy-duddy. Do you see how well the United States has done compared to the rest of the world since the Great Recession? Well, I don't think that's going to continue. It may. I don't know. We don't know. It's called the future. But again, as I said, before the Great Recession, they basically were the same, And so I'm a big fan of investing globally. Now, other people, most notably John Bogle, who was the person who is responsible for Vanguard. He started Vanguard. He started the world's first index fund, and he was a big index fund advisor, a big proponent. And he also says, no, stay in the United States. Stay in the United States. Many of the companies in the United States do a vast majority of the business outside the United States, so you're getting global exposure, but with good old USA. So, there's a difference of opinion. I think. And I notice most younger folks agree with me in that respect. They realize that the world is global. Some older folks, they're darn foreigners. I don't trust any of them while they, drive a Mercedes, which is built in Georgia. Anyway, so slide number 24. The bottom line on mutual funds. Choose a fund family and stick with them. There's a saying in the industry that has been shown to be true statistically. Most mutual fund investors do worse than the mutual funds they invest in. Now that doesn't make any sense at all. How could you invest in the mutual fund? How could you do worse than the mutual fund? Well, it's actually very simple. It's part of us as investors. We are not rational. We wait for the market to go up 100%, and then we say, ooh, is it too late to get in? So we buy the mutual fund, and then the market tanks and it goes down 30% or 40%, and then we say, ooh, is it too late to get out? And we sell the mutual fund only to watch it go back up 70%. Yeah, don't be one of the pigs, as they're called. What's the saying? I get it wrong. Bears do well, meaning people who are optimistic. Bulls do well, investors who are optimistic. Bears do well, people who are pessimistic and think the market's going to go down. But pigs get slaughtered. I'm messing it up, but the idea is don't follow the crowd. I'm not a bear. I'm a bull. I believe that the market's going to do well, assuming we don't blow ourselves up over the next several years. So I'm heavily invested in stocks, and I have been for decades. And it's so far so good. What are you going to say? Okay. So don't be one of the mutual fund investors that does worse than your mutual fund. Reevaluate them periodically, but make changes judiciously and sparingly. And remember, you can always, if you feel you need to, there's a whole army of advisors out there to help you. As you approach retirement, migrate from stock funds to bond funds, but don't give up on stocks entirely. I'm a big fan of balanced funds for people, even in retirement. Of course, everyone's different. What's your health? How did your grandparents? How long did they live? How long did your parents live? There's a lot of issues at play here. But yeah, we want that growth. We want that income. Use dollar cost averaging. $50 a month, $100 a month, whatever you can afford. I know for the most part, it makes investing boring, but it works. Forget about them. Live your life and watch your mutual fund bore you to wealth. I'm sorry if it sounds like an advertisement, but what can I say? I'm fully immersed in this world, and I love it. Thank you so very much for being in our class. As always, dear students, now in our next chapter, we're going to take a look at some investment alternatives that I hope you stay far away from, except for real estate, which is a bona fide, fancy word for a real option in investing. But boy, it ain't easy. Oh, no. So see you in our next presentation when we tackle real estate and other investment alternatives. Why? Because not everybody wants to just invest in mutual funds. Thank you again for being in our class.